Hey everyone, welcome back to the channel, your number one source for income-oriented investing. When it comes to the income world in Canada, especially in Canada, the Canadian banks really reign supreme, right? They are really known as good long-term investments. They're really solid banks, the big six banks, but let's be honest, they've taken a beating lately. And if you're a newer investor, it's possible that you're a bit jittery, you're a bit scared because Canadian investors typically have a nice chunk, a nice portion in the six banks, either directly or indirectly, right? If you're holding the TSX 60 index or a general overall Canadian fund, chances are the big majority is going to be in the six banks because they just make up the biggest part of the stock market. So I've been seeing a lot of fear when it comes to the six banks nowadays, especially from newer investors. There's, you hear all kinds of nonsense out there that the Canadian banks are dead and a lot more trouble is coming. It just makes me laugh as an investor seeing this because, people are forgetting that you got to think long term. You got to think like an investor, and these are financial stocks, which is a cyclical sector, which means it has its cycles. So it doesn't take a genius to figure out why they're down right now. Interest rates have gone up significantly, putting a lot more stress on Canadians, and they spend less money, they borrow less money, and the Canadian banks got to put aside some money for bad loans. It doesn't take Sherlock Holmes to figure out that obviously the stock prices of the banks are going to go down a little bit. So as a long-term investor, keyword long-term investor, it's a great buying opportunity, guys. It's a great opportunity. The banks are very, very cheap. The valuations are very cheap compared to where they are normally. But let's say you don't want to invest in the individual stocks. You don't want to pick and choose, okay, which one do I choose? Scotiabank? Do I choose TD? Do I get all six of them? There's 15 ETFs on the Canadian market which invests either just in the six banks or primarily in the big six Canadian banks. So in this video, I will review all 15 ETFs, and hopefully by the end of it, you will know which ETF is best for you. If you want to invest more in the Canadian six banks, which, it's a great opportunity here right now. And I'll separate it in 4 separate categories. First of all, the first category is just going to be regular ETFs, no leverage, no covered calls. Second category is leveraged ones, but no covered calls. Third category, covered call Canadian bank ETFs. And then the last category is leverage and covered call Canadian bank ETF. So let's get to it. Let's go through these 15 ETFs. We'll compare them, and hopefully my idea behind this video is by the end of it, I want to be able for you to figure out which one or combination is really the best for you, because now it's a fantastic time to invest in these great companies. Let's get to it. So let's go through the first category, everyone. The easiest, the most basic, I'll probably call it the basic Canadian bank ETF. So let's go through them. The first one, of course, is going to be the biggest one, the most popular one by far, ZEB. The BMO Equal Weight Banks Index ETF. So just like the name says, you got the six banks, equal weighted. That's it, everyone. Simple. Almost $4 billion in assets in this one. It's been around for a really long time. You got a management fee of 25 basis points and MER of 0.28. Very, very simple, everyone. Your basic BMO option here, the biggest one by far. Next one is from Hamilton ETFs. It's basically the same concept. It's the same exact thing. Equal weight index. You got the big six banks, equal weighted. By the way, the yields for the equal weighted regular one are all going to be very similar, near the 5.5% to 6% range, something like that, which is, pretty high considering there's no leverage or no covered calls, and that's because the Canadian banks are down right now. So the big difference between the Hamilton one and the ZEB is really the management fee. It's a lot lower. It's 19 basis points instead of 25. The MER is not out yet because the ETF has not been around for more than a year, but I'm assuming it's probably slightly going to be less than 0.28 MER. So a third option, which is very, very similar as well, equal weight, no leverage, no cover call, basic option, everyone, HBNK from Horizons, approximately the same yield. This one actually has the lowest fee out of all of them. 0% management fee and 0% MER until July 31st of 2024. And then when July 31st, 2024 hits, the management fee is going to go to 0.09. So this is actually, HBNK is going to be your lowest fee equal weighted one. If you just want the six banks, equal weighted, super simple. You don't want to have the six stocks in your accounts. You know, a lot of people say, well, why would I get an ETF when I got to pay the management fee? I'll just buy the 6 stocks. Well, it's a very convenient, and it has 0% management fee until next year, and then it will go to a very, very tiny management fee. So your 3 basic options there. Now Horizons does have another option called HEWB. It's the same thing, equal weighted. The only difference is that this one does not give out a dividend, a distribution. The distribution or the dividends of the banks is automatically reinvested into the fund, growing the fund even more that way. The MER though is 0.28, same thing as ZEB, by the way, yeah, 0.28, 25%. Management fee. And you might be asking, okay, why would I get HEWB? Why don't I just get HBNK? Well, this is really designed for people who don't want to pay those taxes on dividends. So in case you got to put this, you're having this ETF in a non-registered account where you pay taxes on your dividends, this is a great option to really delay your taxes. Maybe you're in the middle of your career, you're in a high tax bracket right now, and you're going to hold the banks for a really long time and you know, sell it later. You want to trigger your capital gains much later when either you're retired or you're in a much lower tax bracket. HEWB is a great option for that. Next option, your next basic option is RBNK. This is the RBC Canadian Bank Yield Index ETF. Now this one has a little twist on it. It is the 6 banks. It is not equal weighted. And the yield is a little over 6, so it's a little bit higher yield than the other ones, and I'll explain why in a second. Let's just go through the management fee. You have at here 29 and 32 basis points. So, and by the way, from all the ones they all have monthly distributions, of course, except for HEWB, which has no distributions whatsoever. The rest are all monthly. So what is the deal with RBNK? Well, you'll actually find the explanation of what this ETF does in the fact sheet here, in the ETF fact. So what they do is they do a weight based on the indicative annual dividend yield. So they're making the banks with the higher dividend yields a bigger portion of the portfolio. So you see that here. What they're doing is the 2 highest dividend yielding banks will receive a 1/4 weight, which means those 2 banks will literally make up half the fund. The next 2 highest ones will have 1/6 of a weight, and the lowest 2 dividend yielding banks will have only a 12th of the weight. So you actually see the separation here. So what this tells us is that currently right now, this is as of March 31st, 2023. So it could be different now, just as an FYI, but you could see that, let's just say as of March 31st, 2023. I don't know if it's that situation now. CIBC and Bank of Nova Scotia, out of the 6 banks, have the highest dividend yield. So that's why they make up 50% of the fund. Then the next 2 highest dividend yield is BMO and TD. So you see that they have the next biggest portion, right? The 1/6 of the fund weight, these 2. And then the lowest ones, National Bank and Royal Bank, are going to have the smallest percentage because they have the lowest dividend yield. So pretty unique concept, I guess. Now this means that obviously you'll get a little bit higher yield because they're putting more focus or putting more weight to the higher dividend ones than the equal weight ones like HBNK. So I looked at the HBNK, HEB and ZEB, which have about 5.5, 5.6, 5.8, 5.9. So this one I actually check, it has a tiny bit over 6% yield. So you're making a little bit more yield. So very unique option here. But again, a basic option because there's no leverage, there's no covered calls. And then the last but not least basic option is the Hamilton Canadian Bank Mean Reversion Index ETF, where it's still the 6 banks, but kind of like RBC or the RBNK, puts a little twist on it where what they're going to do is they're going to invest, or the weight is going to be 80% of the weight is going to be on the 3 banks which have recently underperformed, and 20% in the 3 banks which have outperformed. So they're putting their basic premise behind this is like, look, all 6 banks tend to perform similarly over time. So if you're holding it long term, why don't we try to put the biggest majority in the banks that are right now underperforming, and then 20% in the banks that are outperforming to try to capture more alpha, more profit long term, right? Higher long term returns. And it turns out that you have the evidence here that if you, I guess, would have had the equal 6 banks in 2007 and versus this strategy, you would have been better off with the mean reversion strategy. You would have had a higher total return. So this is kind of interesting if that makes sense to you, if you kind of like that concept. And as you can see here, the big Bank of Montreal, Bank of Nova Scotia, and CIBC make up over 75% of the fund right now, whereas TD, Royal Bank, and National Bank are the bottom three, because they're, these three banks, what they're saying is TD, RBC, and National Bank are outperforming, or they're doing better than CIBC, Nova Scotia, and Bank of Montreal. So pretty interesting. Yield is about, this is 6%. It's probably a bit outdated. It's probably as of October 1st. So I'm assuming it's probably like 6.2, something like that percent. And the management fee is 29 basis points. So that's it for the basic or regular Canadian bank ETFs. If you just want your basic option, you don't want leverage, you don't want covered calls, one of these is definitely going to be for you. All right, everyone. So when it comes to your basic leveraged Canadian 6 banks ETFs, you have two options really. So these ones use but they both use 25% leverage but no covered call. So you would want these if you really believe in the banks long term, you're really bullish on them, and you don't mind having a little bit more volatility for potentially more long-term growth and total return, right? If you're adding leverage to quality, typically long-term, it's going to be your friend. And I can't think of any something better to add a little bit of leverage to than 6 banks. So I really like these ones. If you're really a more of a total return growth long-term investor, I think these are a perfect fit. So you have HCAL from Hamilton ETFs. Of course, 25% leverage is going to mean a little bit more yield as well. So you see the yield probably about 8.5% now, something like that, because this is from October 1st numbers. And I'm filming this at the end of October. So it's basically equal weighted 6 banks with 25% leverage. That's it, guys. It's very simple. If you actually look in the ETF to see what's inside of it, all it is their HEB ETF, which is the equal weight, with 25% leverage. So it's basically 125% exposure to HEB. This one has been around for quite a while, mid-October of 2020. It has a lot of AUM. Management fee is 65 basis points, but because there's leverage in there and interest rates have gone up and leverage costs have gone up, I mean, the MER will be higher because the MER does include leverage costs. Let's not forget that, right? So if you're very bullish, you're very optimistic long-term, something like this would be great. And BNKL, this is a bit newer. Also from Horizons ETFs, it's the exact same concept. Equal weight with 25% leverage. So if you look at the holdings, you will see their own equal weight ETF, which is HBNK, which we've just reviewed, at about approximately 125%. This one though has a lower management fee, 35 basis points, than the Hamilton one. Got to point that out. The MER is not available, however, because this ETF has not been around for more than a year. The yield's a little bit lower as well than the Hamilton one. So if you don't mind a little bit of leverage, 25%, it's very modest, it's very light leverage, it's not a lot, but you will have 25% more volatility. If you don't mind that, however, these two could be a great option. On to category number 3, your covered call options now. All right, guys, let's go through the covered call Canadian bank ETFs without any leverage whatsoever. You have 4 options here. So ZWB is the biggest, most popular one at 2.6 billion here. This is your basic, equal weight Canadian banks with covered calls. So of course you're going to get more yield, and of course the management fee is going to be higher, right? Because writing covered calls takes more work than just a passively indexed one. So you see that here, it's about 8.42% yield. And as we know, BMO does their covered call policy, which I've discussed and even many times on the channel, even discussed with the covered call fund managers at BMO. They do out of the money calls on approximately 50% of the portfolio. So it's not an aggressive strategy when it comes to the covered calls, which means by default you are participating in more than 50% of the upside when the banks go up, because it's on 50% of the portfolio and they're doing out of the money calls. So you're capturing some upside. So if you want a little bit more yield, monthly income as well, you have a nice yield of over 8%. ZWB is the most popular and really your most basic, if you ask me, covered call Canadian 6 bank ETF. CI also has one called CIC. The management fee is exactly the same, MER 81, MER 71. So the MER is a little bit higher. Same exact concept, except the only difference is that, let me just see here. Let me just make sure distributions. The distributions are quarterly with CIC instead of monthly with ZW. And by the way, out of all the ETFs we've covered, just this one is going to have quarterly distributions. If you look at the performance, the covered call strategy is a bit different. CI does up to 25% of the portfolio, not 50, but they do at the money calls instead of out of the money calls. I looked at the performance real quick. You could check it out. You could compare CIC versus ZWB. It's very, very close in terms of performance. The next one is BKCC. So this one is much higher yield. This one is from Horizons. It's, as you could see, over 14% yield. And of course, if you're getting more yield, it means they're doing more covered calls. So if you look at the strategy, you could actually see the calls. So I really like Horizons website. You actually see the calls here, the documentation on the covered call percentage. You see it's at 47% written. So you could say it's about 50% coverage, and Horizon's new covered call policy on all their covered call ETFs, except for HGY, the physical gold one, is they could write up to 50%. So this one is right now is just under 50%, and they're pretty much, they're 0.9% out of the money. So they're pretty at the money call. So this is going to be a lot more covered call writing, right? Which means you're getting much higher yield. As you could see, I mean, from 8 to 14, it's much, much higher, but you are giving up more upside when the banks go up. So it is a yield return trade-off. And the management fee is actually pretty good. It's 39 basis points. So it's actually the lowest one here. They recently did a reduction from 65 to 39, and the MER is 84, but I did confirm with Horizons, it's actually 80. It's about 56 because it's, whatever the difference is between 65 and 39, whatever that discount is, you got to apply that discount to the MER, and it's only going to be updated next year. So the MER, when it comes to the fees, this is going to be your lowest fee Canadian covered call Canadian bank ETF. And last but definitely not least is HMAX. This is your highest yielding option. Right now it's even past 16%. It's like 16 and a half, because again, they update them at the beginning of each month, and I'm filming this near the end of October. And this one is actually not a pure Canadian 6 banks. If you actually look at the overview and you look at the holdings, you do have the 6 banks, but you also have other financial giants in Canada. You have Brookfield, you have Manulife, Sun Life, Great West Life, and Intact. So a couple of insurance companies in there and asset managers. This actually is, they're the top 10 biggest financial companies, but about 75% of the fund are the 6 banks. So I decided to include this one as well. And this cover call strategy, just like a lot of their yield maximizer ETF, it's on 50% of the portfolio at the money call. So obviously you could have guessed it right. This is the most aggressive cover call strategy out of all of them, which means you give the most upside, but you gain the most yield. Management fee on this one is 65 basis points. Yeah, here it is right here. So there you have it, your basic. And by the way, if you're interested in HMAX a little bit more, because this is the income channel, right? Passive income channel. It is the highest yielding one. Check out my review video that I did 8 months ago. Here it is right here, HMAX 13% yield plus. And I also encourage you, if you're hesitant or if you're, how can you get 15-16% yield? It makes no sense. You could also check out Brandon Beavis's channel. His dad made a great video on HMAX, and he actually shows the options chain and how really you can make this sort of yield when you're writing at the money call. So these are the 2 videos I strongly suggest you check out if you're interested in HMAX. So there you go. These are your covered call ETF options that do not use leverage. Now, finally, the 4th category, covered calls and leverage. And I have to say, these are my favorite. Let's check it out. So if you want covered calls and leverage, this is my favorite category. You have 3 choices here. And remember, guys, split funds are not being covered here because I'm just doing ETFs in this video, in case you're asking. So split funds do use leverage and covered calls, a lot of leverage, much more than 25%. But this video is just going to be on ETFs. So first option, you got 3 of them. Your first option, and I have to admit to you, this is my personal go-to when it comes to investing in the big 6 Canadian banks. It's the one with the highest yield. it's BKCL from Horizon. So this is very simple to understand. It just holds BKCC, which we've already reviewed. It's the regular basic covered call one with 25% leverage, and that's why you see 125% of BKCC. So very, very, very simple, everyone. BKCC with 25% leverage, an enormous yield. They just recently announced their new distribution, which is a little bit lower than their last one. It's 24.5 cents instead of 25.7 cents, but it still translates to an enormous yield of over 17% right now. Keep in mind these, for all of these ETFs, by the way, especially the covered call ones and covered call leverage ones, they can fluctuate because covered call income options premium can fluctuate. So BKCL, your highest yielding one out of the 15 at over 17% yield. Now, this is the one I have personally invested in the most. And this is only the 6 banks. The next option, which I also own myself, I also own a small position in this one as well, is Bank from Evolve ETFs. This is the Canadian Banks and Lifeco's Enhanced Yield Index Fund. So this is not just the 6 banks. It's 60% the 6 banks and then 40% in 4 other companies, which of course you'll recognize. The other 4 companies are Manulife, Sun Life, Great-West Life, so top 3 insurance companies, and also Power Corp of Canada, which owns Investors Group and Great-West Life. It's a very big asset manager. So this is index-based ETF, right? It basically, 10 of the biggest banks and insurance companies in Canada. It is a covered call. They do covered calls. The covered call strategy from Evolve is they do it up to 33% of the portfolio. So not as aggressive as the Horizons and Hamilton ones when it comes to covered calls, because it's up to 33, not 50. But there's also 25% leverage on this one. So this one has a very nice yield right now of probably, it's a bit higher than that now because this is from October 1st. I think it's 16.5, maybe even 17% yield. So I think this is going to be your second highest yielding one. Maybe, very close yield to HMAX probably. And remember, it does not have just the 6 banks. It's 60% in the 6 banks, and then there's 4 insurance companies. So the management fee is actually pretty decent on this one. It's 60 basis points, 0.60, but the MER is going to be 1.7. And remember, the MER does include leverage costs, everyone. All right. So that's Bank, another very, very high yielding option here. And last but definitely not least, I recently reviewed this one on my channel and spoke to the CEO of Mulvihill about it. Here is the video right here in case you're interested. Is CBNK. This one has about 12% yield, 11.5, 12% yield right now. This one is very interesting. First of all, it is only the big 6 Canadian banks. They do have 25% leverage, but it has 100% upside because they only write the options, and they write cover calls and put options, by the way, only on the leveraged portion, only on that 25% leverage. So this is a really interesting one where you want higher yield with options, you like leverage, but you're more oriented towards you don't want to give up upside. You don't like giving up upside. You want higher yield. You don't want to give up upside. CBNK could be a great option because they only write the calls and the options on the leverage portion of the portfolio. So by default, the 100%, you're capturing the full upside of the 6 banks. So I thought this was a very interesting option. Management fee is 65 basis points, but the MER is a tad higher at 2.21 here. And if you're interested to know more about CBNK, which I find is very unique, check out this video. I speak to the CEO, Mr. John Mulvihill, all about this ETF and why they decided to go with this strategy. So that's it, everyone. Hopefully this video was informative for you. I know there's a lot of options. I tried to separate in 4 categories not to confuse you, but it's really, you got to remember that all 15 ETFs are all invested in the same stock. So the risk is very, very similar for all of them, because the main risk for any ETF, whether it's leverage, whether it's covered calls, whether it's basic, risk number 1, risk number 2, and risk number 3 are the underlying stocks, which in this case, all 15 of them hold quality blue chip stocks in Canada, right? The 6 banks. Some of them hold a little bit other stuff, but even though they're also quality. So it's really up to you to figure out which one is best for you. Do you just want the basic option? You don't want the covered calls, but you don't mind a little bit of leverage. You just want the basic covered call option, or you just want covered calls and leverage. Let's go, right? So there's no right or wrong which one is best. It's which one is best for you. I'm out of breath, so see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.